Welcome back to Options Hedging for Beginners. In our previous segment, we covered what options are, sources of risk, and the components of option premiums. Now, let's explore a key element of any option contract, the strike price.
The strike price, also called the exercise price, is the price at which the option holder can buy or sell the underlying asset when exercising their option. It's one of the most critical specifications of an option contract because it directly impacts whether an option has intrinsic value and how it behaves relative to the underlying asset's price.
So the strike price creates that crucial reference point for determining what the option is worth. How are strike prices typically structured in the market?
Great question. Strike prices are set by the exchanges following standardized rules. For most stocks, strike prices might be set at $2, 50 intervals for stocks trading below $25, $5 intervals for stocks between $25 and $200, and $10 intervals for stocks above $200. Higher priced stocks like Amazon might have even wider intervals. We categorize options based on their strike price relative to the current stock price. An option is in the money when it has intrinsic value. For calls, that's when the strike price is below the stock price. For puts, it's when the strike is above the stock price. Out-of-the-money options have strike prices approximately equal to the stock price, and out-of-the-money options have no intrinsic value.
Those categories make sense. Can you walk us through some examples of how different strike prices might be used in actual trading strategies?
Sure, let's say Apple is trading at $150. If you're bullish and expect a large upward move, you might buy a call with a strike price of $155 or $160. It's cheaper than an in-the-money option, but requires a stronger move in Apple to become profitable. This gives you more leverage but a lower probability of success. For a more conservative approach, you might choose an in-the-money call with a strike of $140. It costs more but has a higher delta, meaning it moves more directly with the stock. If Apple rises to $160, this option will gain nearly the same amount as the stock itself. For hedging, let's say you own 100 shares of Netflix at $400 and want protection against a potential drop. You might buy a protective put with a strike of $380. This gives you the right to sell at $380 even if Netflix crashes to $300, essentially limiting your downside risk to $20 per share plus the cost of the put option.
Those examples clearly show how different strike selections serve different goals. It seems like selecting the right strike involves balancing cost against the probability of the option ending up valuable.
Exactly. Choosing a strike price is all about balancing risk, reward, and cost. In-the-money options provide higher probability of success but cost more and offer less leverage. Out-of-the-money options cost less and offer more leverage but have a lower probability of success. The right choice depends on your market outlook, risk tolerance, and specific strategy.
In our next segment, we'll explore option expiration and time value, how the clock affects your options and strategies for managing this critical factor. See you then.